What will you do if you get some surplus funds today? How do you make sure that you get the best possible returns for those funds? Market is full of a variety of products, advisors and brokers. Making the right choice is not easy. This video will give you a framework for portfolio assessment and financial planning. It will also help you understand if your current portfolio is well balanced or not, and to take remedial actions as required. This framework is a 2x2 matrix that gives you a perspective of the various products that you will come across in life and will enable you to see them in the right perspective. Note that we are not getting into specific product details here. We start with the baseline at the center of the axis. On the horizontal axis, we have debt on the left hand side and equity on the right. So as we move leftward, the lending risk increases, and as we move rightward, the ownership risk and volatility increases. The vertical axis represents time horizon. It has set maturity on the bottom and flexible maturity on the top. Set maturity products will have a predefined maturity, as in the case of a fixed deposit, whereas flexible maturity means that the maturity is left as per user decision and is not predetermined. As we move away from the baseline, time horizon increases. So we have 4 quadrants here: equity with flexible maturity, debt with flexible maturity, debt with set maturity, and equity with set maturity. Equity with set maturity is like a misnomer, and you won't find many products here. Most prominent quadrants are quadrant 1 and quadrant 3. Considering the learning journey and complexity of products, you normally start placing your funds in debt category, which are more of guaranteed returns, and then move to the equity space as you gain expertise. Let's now have a look at the various products on this matrix. I have tried to place them in the order of the learning perspective. We start with the current account and savings account, which are debt products with flexible maturity. Then comes the products in the debt category with set maturity, which are fixed and recurring deposits. Debentures and bonds issued by corporates and governments comes next. This is followed by PPF, which can be opened by anyone, and PF and VPF, which can be opened by employees. Now we move to the flexible maturity side with debt mutual funds or ETFs, followed by hybrid mutual funds or ETFs, which is a mix of debt and equity instruments. Now we move fully to the equity space with the equity mutual funds or ETFs. Note that there are many other subcategories in the mutual fund space. This is followed by small cases, which is nothing but a basket of stocks or ETFs. Then we move on to stocks, which are focused equity investments in the ownership of a given company. Then we have the traditional ownership products such as gold and real estate. Now let's move on to certain non-traditional products. First one, the market-oriented retirement product called NPS or the National Pension Scheme, which mixes equity and debt in varying proportions as per investor preference and provides growth and pension annuity. Its maturity period is set as per the retirement age by Government of India. Second, we have the perpetual bonds, which are bonds with no maturity. And third, we have good crypto, which are investments in the crypto or blockchain space. Perpetual bonds and cryptos are highly risky investments. Recent write-offs of the perpetual bonds by Yes Bank had left many investors in distress. And when it comes to crypto space, it is filled with instruments ranging from pure gambles to fundamentally strong coins, and many of them are not approved by governments or regulators. So, one must study very well before making investments in these two categories. Understanding the scope of this framework is very important for you to apply it in your lives. First, most fundamental products are covered here. There are other variations of products in market by various names, which are nothing but combinations or derivatives of these products. Example, guaranteed plans, ELSS, etc. Second, covers such as life insurances, health insurances, etc. are not part of this framework, as they are for your protection and not investments. Third, time horizon shown for products is just an optimum illustration from our experience. Do not take it literally, but take conscious calls as per your needs and the market situation. Now let's go back to the original question. What will you do with your surplus funds? Say you have got 2 lakhs rupees as annual bonus. You have to follow just simple 3 steps. First, assess your current portfolio and understand its spread. Say already you have 20% in stocks, 25% in mutual funds, 25% in FD, 20% in PF and say 10% in NPS. Remember that our aim is not to buy all products, but ensure a spread across the quadrants, especially quadrant 1 and 3. Step 2. Now you have to prepare a plan for your surplus funds based on your timeline of needs. You can check the earlier video on financial wellness through budgeting to get guidance on this planning process. Let's say out of this 2 lakh bonus, you need 50,000 in another 3 months and rest is not required in the near term and you can invest it for long term. So now we come to step 3. You have to identify products based on this time horizon that you have planned. Shorter the timeline, choose products closer to the baseline. So for the 50,000 that we need in next 3 months, you will either choose an FD or a debt mutual fund to park the money. And for the remaining 1.5 lakhs, you will choose from PPF or equity mutual fund or stocks or even gold or real estate as it's a long-term investment. So that's the framework in action for you. Only prerequisite here is that you should only go for those products which you have learned and have conviction in. For a new investor just embarking on his wealth journey, it will be ideal to go in the order in which I presented the products to you. Normally, preference of products in the chart is seen to go from top to bottom with age, which is a standard advice in the market as well. That's why you will see the non-retirement products in the third quadrant. But a better model is to have product preference going bottom to top as you build your expertise. So, you start in the safe zone, which is the third quadrant, and move to the growth zone, which is the first quadrant as you gain expertise on those products. Then as you approach the timeline for a financial need, you move towards the baseline. Say for example, if you have your funds in stocks and will need it in next 1 to 2 years, move it to the mutual fund space and then move it to a fixed deposit as you move within a year. All the best for putting this framework into action for your portfolio.